Cookie, welcome back, mate.
Thank you, Mark.
You
Good to be back,
You got
I
a
think.
nice tan there.
Oh, mate, a month in Greece, what a delight. It was just fabulous. You know, Athens, of course, and all the magnificent ruins and history and food. But then going around to the islands, absolute magic, absolutely beautiful place to visit.
And what about economic? How's it look?
Oh, as an economist, of course, I look at the economy and, gee, that's what made me pretty sad, to be blunt. You know, they had that legacy. Remember the Greek crisis in the global financial crisis 10, 11, 12 years ago? They are still living with it. Driving around, walking around the cities and even the towns on some of the islands, there are, you know, more than a few unfinished buildings. And when you sort of chat to a few of the locals, when you're having a dinner or a drink or something, you know, what's happening here? They say, oh, look, the economy's still pretty grim. Those properties that are just a shell of a property, they were started 10, 12, 15 years ago. The banks pulled the money because they went into that almighty economic slump, a depression, you could even say. And there's still a legacy of that there now.
So, but nonetheless, they still no doubt of fun. And of course, today's the 20th of October. We can't get past the 28th of October. It's Orchi Day, which is the day that the Prime Minister at the time in World War II or prior to World War II, just before World War II started, said no to Mussolini. Mussolini said, let us take control of your country. And of course, Metaxa said, forget it. And today's Orchi Day. So for all those Greeks out there, Steve and I want to wish you the best for Orchi Day. And
Indeed.
Zito Elada. Long live Greece. Right, let's get into it, mate.
Okay.
Inflation this week. Tell me what happened.
It was high. In a nutshell, we had the headline figure at 7.3 in annual terms, 7.3%. And you've got to put in the context. The target is 2 to 3%. So, boy, we've blown the top of the target. And in a sense, we knew inflation was going to be high, but even the market experts thought it wouldn't be quite this high. So that came in. You know, we know that building costs, we know that a lot of food prices, even petrol prices were still elevated in the September quarter. And we got this 7.3% headline inflation rate. If we look at what the RBA likes to look at, when you take out the price of lettuces, for example, and those sort of things, which are very volatile, the underlying rate was still above 6%. So that's above market expectations too. So we have an inflation problem. It's elevated, it's high, and that's why the RBA's been hiking, and probably why there's one or two more rate hikes to come.
Well, on that, are we seeing what we're seeing in the US and UK, even worse, really stubborn inflation, notwithstanding what we all think is going to happen? We think the mortgage rate is going to do something, increase interest rates for business is going to do something, you know, all the rhetoric is going to do something. In other words, tell us all to stop spending. Do you think that we might have a stubborn inflation here?
We're right in the middle of that grey area. So that's the question that's on everybody's lips in financial markets, in capital markets. That's why we're seeing, you know, US stock markets gyrating more than they normally do. You know, the yield on government bonds changing massively every day because there's a bit of news and a bit of analysis from Fed officials sort of working out what's going to be happening to inflation. So the jury's out. In my opinion, I look at what causes inflation 9 times out of 10 in each inflation cycle we have. 1, very strong economic growth. 2, very tight labour markets, so wages pick up. And 3, commodity prices booming.
All of which create liquidity.
Correct.
Put money in our pockets.
And indeed, if we look back a year to 18 months ago, all of those things were happening. We sit here now and have a look into 2023, or even where we are today, and you can sort of see growth is slowing around the world. No question. Commodity prices are coming off. They're still high compared with where they were, say, 2 years ago, but that peak has been achieved. And labour markets, while they're still very tight, and even here in Australia, you know, a couple of weeks ago we had our September labour force numbers, jobs growth was basically nothing. So in the last 3 months, we've not had any net increase in employment. The unemployment rate, lovely and low at 3.5%, but it was 3.5% 3 months ago. So we're not getting that improvement. So you can sort of say that the momentum on inflation has certainly topped out. It's just not showing up in the inflation data. And your question is, well, will it be sticky? Will it be persistent for a while? That's the, dare I say it, the stagflation question. Do we get a weaker economy and rotten inflation stays too high for too long?
Yeah, and that's a worry.
That would be the worst case scenario because we know from history. Back the last time this really happened in a big way was in the 70s, and policymakers didn't know what to do. Do they hike because of high inflation? Do they cut because of weak growth? Do they, what do you do with the budget? Do you spend or not spend? We know what to do when inflation's high and the economy's booming, you hike. When inflation's low and the economy's weak, you cut. When you've got the cocktail of weak growth and high inflation, it's a real dilemma. Now, we're not quite there yet. We know that the Fed's still hiking. European Central Bank hiked 75 basis points earlier this week. Bank of Canada hiked 50 earlier this week. So, central banks around the world are still hiking because they're more worried about inflation than growth. But, we're getting into that grey area very soon that unless we start to see not just tentative evidence, but hard evidence that global inflation momentum's turning down, we might have a bit of a dilemma in 2023.
How much of a lead are we taking here in Australia from what's going on, let's say, in Europe, but probably more importantly, US?
Yeah, we don't quite have the inflation problem. So if we can give ourselves a mini pat on the back, our 7.3% inflation rate, as we were just chatting about, is the highest since 1990, so a 32-year high. The US inflation hit 9%, UK 10%. We're probably going to top out next quarter at about 7.7, 7.8 thereabouts. So not quite as bad. I'm not saying it's great, but we don't have quite that inflation problem, partly because we don't have the same wages momentum, that critical issue that was in the election campaign and we know is an important cost of living issue. So our inflation rate's not quite as problematic as in those other countries, which probably explains why our interest rates are a fraction below what they are in Canada, are in the US, are in New Zealand, for example. The momentum's still down, and with another rate hike to come, or two, which we'll chat on about in a minute, but the momentum on house prices still seems to be down for now. We haven't reached a bottom yet. So probably my 7% will be too optimistic, as in they'll be a little bit
low,
more severe than that, might be minus 10. But I don't think we're going to get Chris's minus 20 either, which was the midpoint of his forecast. So because already we're seeing, the auction clearance rates, and I know they're not the best indicator of prices, but they're not bad either. They've sort of stabilised in the low 60s in Sydney and Melbourne, so the two biggest areas and the two cities that have had the weakest prices so far. I look at Perth and Adelaide, and their prices are only down fractionally at this stage. Now, maybe they can fall further. But if we are near the end of the rate hiking cycle, which I think we're nearer the end than the start, so that's a bit of good news in terms of that momentum. If we do look at what happened in the budget earlier this week, a big increase in immigration, not just this year, but for the next couple of years, that's a hot demand for property from 500,000 people coming into the economy over the next couple of years. So you fix the labour market problem, but you might create a bit of demand for housing. And you look at the rental market, which is as tight as a drum. The rental vacancy rates just about everywhere are incredibly low. Rents are picking up. We saw that in the inflation numbers. Maybe that supply and demand factor, the tightness in the rental market, we'll see house prices bottom out. I still reckon about the first quarter of next year. So the timing's still the same, but we might not get that 20% that Chris is talking about, but we'll probably get something worse than the 7% that I was thinking.
So just on the migration numbers, the 2 million visas that have been processed by the Department of Immigration, and the minister has mentioned that. What does that mean? What is that likely to do to rents, house prices, jobs, demand, unemployment, etc.?
Yeah, we know that when we were locked down during the COVID pandemic, we couldn't get backpackers coming to pick the fruit. We couldn't get casual workers coming in, which a lot of semi-skilled, low-skilled workers were actually being able to achieve. And businesses were screaming. They were really finding it tough to do things, let alone if you're in a business that requires highly skilled workers. So now that we've opened the borders, and as you said, the 2 million visas have been approved, so those people can stay here and they can work. So all of a sudden you can get businesses are saying, we want to employ you, and the person's inevitably going to say, yes, we want to keep working. So it fixes the labour market skills shortage problem, which was acute, no question. But where are these people going to live? The new immigrants that are going to come in the next few years, what house or apartment are they going to live in? Where? Sydney, Melbourne, Brisbane, or somewhere else? And when you've got such a low vacancy rate, so if they're going to rent, they're going to be pushing up rents even more. And Lewis Christopher from SQM Research has got some great stuff on the rental prices. His numbers are showing that rents are going up at 15, 18, 20%, depending on which city you're in. Like, that's incredible increase in rent. And here's another 500,000 people coming in, and while housing construction's pretty good, it's not that strong.
Well, can I just unpack that for a second? So when
Yeah.
they say, when the minister says, I've processed 2 million visas for immigration, does that mean that there's 2 million people about to turn up to Australia? And what is
Some
that?
of them were here already, but they hadn't been
Right.
processed. So
Okay, so how do I sort of know what the deltas, the additional number of people are going to be now here, putting pressure on the unemployment number?
Yeah, that 2 million, it's very hard to work out who's here and who's not, because again, when the borders were locked down, a lot of people who were here on visas just stayed because they couldn't leave the country, and even though they didn't have their visas processed. So that addition to employment, addition to housing is probably going to be neutral, no net effect. But for new people coming in, that's the critical issue. And as we're already seeing in the university sector, there's a big influx of foreign students coming back in. They inevitably rent in the campuses near where, the uni that they're going to. So the apartment markets, again, as I was saying before, is as tight as a drum. It's very hard to find rental accommodation near the universities. So that whole immigration, visa count, universities reopening, tourism coming back is just putting, a bit of pressure on the housing market.
So if that's the case, then could that influx of new people create what's happening in the US, a rental-led inflationary crisis?
That's the fear again.
That's what I've heard Powell talk about.
Yeah.
Rents are heavily weighted
in the inflation numbers, correct. And here in Australia, if the numbers that SQM Research are finding translate into the official inflation numbers, and they're starting to, the last quarter, the September quarter numbers, which came out earlier this week, did show a pretty big pickup in rents. Still not as high as what Lewis is sort of finding in his numbers, but with a lag. I think they measure them slightly differently. So, but nonetheless, if that shows up in 10, 15% year-on-year increases in rent, that's going to put, that puts about half to 3/4 of a percentage point on inflation if nothing else changes. And, we do know that the cost of energy, international travel, hotels, and all this sort of stuff is going up at a rapid pace as well.
Yeah, so these are the things that contribute to what I call the stubborn inflation, something is hard to rub out. And it seems like every solution that they come up with actually creates a further problem. So we need to bring more people in to take pressure off wages. Small business owners and employers can employ people and don't have to just keep paying more money for the people they got, and also can have enough people on the floor, no matter where it is. But that in itself will create a further problem, given that we've got such a shortage in housing.
That's you push on one side to fix that, and you create a bubble on the other side. And I think that your summary is spot on, because we did have a labour shortage. We needed workers. Firms were screaming that they needed people because they've got a business plan, they can't find workers. So fine, have some sort of immigration, and that's the dilemma that the previous government had and this government has. It's one of those things that I won't be critical of either government for the number that they put in, because what's the magic number? You can have immigration that's too low, and that's what was happening when we were locked down, obviously, and you can have it too high when you actually do put downward pressure on wages, but you put pressure on congestion in the cities. A lot of the things that we found in the prior to COVID even was the congestion that was occurring because we had millions of people coming in without public transport being built, without the roads being built, let alone without enough houses being built. And so are we in the early stages of not something that's going to change housing tomorrow, but in a couple of years' time, we'll look back and think, wow, housing's recovered strongly, hasn't it? And it's because of this population growth relative to our ability to build new houses to house these people.
Well, let's look at that for a second then. Housing, and not dwellings as opposed to houses, but let's look at dwellings generally. One of the consequences of rate rises has been, we're all talking about it, will house prices reduce by 20% or 15% or 12%, some other number, whatever it is. One thing is we know they're going to reduce. They are reducing. We don't know by how much. It's going to be somewhere between what the current number is, like 7 or 8%, up to some other number, maybe somewhere between where we are right now and where Christopher Joy was modelling, say 20%. So whatever. But then all of a sudden, all these people come into Australia and they start saying, I now need to live somewhere.
Yep.
And our current crop of new housing is going to be low. The reason for the number of new approvals being low is because it's harder to sell these houses, therefore it's harder to get the finance approved, and there's a lead time. I remember speaking at the Australian Economic Forum, which you invited me to come along to,
Yep.
and I think I debated with what's the guy? Ross Gittins.
Ross Gittins, yes, from the Sydney Morning Herald.
From the Sydney Morning Herald.
Yep.
And I remember Ross had his suit on and a pair of sand shoes. I remember that. And this is some years ago. But one of the things I raised was the lead time it takes to get supply of new dwellings.
Yep.
And in this country, it's quite a long period. And then you've got to get approvals, financing approval. And funding approval usually relates to a level of pre-sales, which is called pre-sales equal to what they call the TDA, which is a total TDC, total development cost. So the lender, banks, say, sure, we'll lend you $10 million to build these houses or these block of apartments, but you've got to sell $10 million worth of apartments now, pre-sold.
Yep.
And the rest of them you don't have to sell, but you just got to show us there's 10 million being sold, pre-sold with deposits, blah, blah, blah. But it's hard to sell.
Yep.
And also you don't want to sell now because there's a shitty time to sell. You're not going to get the best price. So as a result of that, developers pull back and they say, well, we're not going to do anything right now. We just land bank. Keep the land and we'll wait for things to come back. And I think the lead time today is somewhere between, because of COVID, application periods, I'm not joking, are 3 to 4 times as long.
Wow.
Because no one goes to work to councils anymore. They all work from home. So, and there's a bank of unapproved applications already. So I think the supply of housing to fit all these new people who are arriving in Australia in over the next 2 or 3 years is going to be undercooked. And I therefore think maybe, and I'll seek your opinion on this, maybe house prices might start to get a bit of a fillip as a result of this, particularly with investors.
Yes. And I think that argument's true because at the end of the day, supply and demand is a really important structural issue for house prices. Interest rates cause them to go up and down. You know, with rate hikes, house prices
Well, that's about affordability, but not demand.
Correct. So, and the other thing that you touched on there quite rightly, when you think about the migration policy that was announced the other day, it's skilled migrants. So you think about what that means. A skilled migrant is generally someone who's young, educated, and will step straight into a job. They're going to be earning money the day they arrive, basically, and probably good money because they've got the skills. So what that means also is that they can afford to buy a house. So while we might still think, oh, gee, rents are really high, that's a real problem, and house prices are high. And yes, they both are. Rents are high and house prices are damned high still in Australia. But if someone who comes in here to work, gets a job, a good paying job, they need to live somewhere, they will demand a property. The other thing that is simmering, you know, we're not quite there yet to say, put my hand on my heart and say house prices are about to turn, is the investor market. You know, talking about rental market, investors might just be ready to step up. And by that I mean when they can sort of see the tax rules are not going to change, negative gearing, that debate's gone, so they don't have to worry about that
And
yet.
by the way, a fantastic opportunity because it's the most efficient tax acquisition or asset class in the world, Australia.
Indeed. So if you're in a potential property investor, you're going to say, well, gee, if I do buy an investment property, I get the tax benefits. If I do buy an investment property, given the tightness in the rental market, it'll rent like that. It won't be vacant for 3 months before I find a tenant. And the rent I can ask will be here, not there.
And
it'll be elevated.
And maybe it's even going to go up more.
And as we're just discussing on the rents into the CPI, into the inflation numbers, you might be putting up. Now, that's a harsh reality for people who are renting. No doubt about that. I agree completely that there is an issue there about rents being very elevated. But from an investor perspective, from that perspective of someone saying, gee, what am I going to do with my money? It's a pretty good time to be stepping into the property market.
Which means more demand.
That's probably more at the lower end.
But for less supply.
Correct. And there's not much supply, as you said. The number of new apartments coming onto the market, and it tends to be apartments.
And where those two curves meet, what happens, Steve?
Prices go up.
That's price.
It's pretty simple. It's Echo 101. Yeah. I don't know who's listening's done Echo 101, but supply and demand are the biggest drivers of price. If you've got hot demand relative to subdued supply, prices go up.
Everybody tends to think this is all about affordability because interest rates are high, but it's actually about supply and demand. Affordability determines price. but supply and demand is still there. So it just because things are more expensive than they have been in the past, start again. Just because interest rates are more expensive than it has been, say, 6 months ago, doesn't mean people still don't have demand to go and buy a place or rent a place, one of the two.
Yeah.
And they're going to pay something, and it might just level the prices out for us at the moment. And so I quickly need to touch on something, Steve. The Treasurer, Dr. Jim Chalmers, announced his in the last few days announced his budget, mini budget. Like, I don't know why everyone's carrying on saying mini budget. It's not the real budget. Like the real budget's in May. But anyway, it's his mini budget. There's a lot of focus on it. What'd you read on it?
Look, it was more just a process. There was nothing big in there that shocked people. And in a sense, that's probably a good thing.
Yeah.
They implemented a number of their policies that took the election, childcare and pharmaceutical costs going down and a few bits and bobs like that, which is fine. They won the election. They let them implement their policies. But it was also more just an update on what are they thinking about the economy? What are they thinking about the budget bottom line? And so when you read through the policy changes that occurred there's nothing much that happened. And as Jim Chalmers is saying, the real work's starting for the May budget. So if we're talking about, tax reform, or what do we do with stage 3 tax cuts, or what are we going to do with other tax policy
changes,
wait till May. I think that's going to be the big bang of policy from the new government. That this was, as you said, a mini budget. Yeah, when I stop back and look at it, it was fine. And one good thing, and again, the experience from the UK over the last 2 months when they blew up their capital markets, the fact that people are saying, it's a pretty standard, boring document, I think is a good thing.
Well,
that he
from
didn't
a rating
scare the
point
horses.
of view and market's point of view, it's good. It looked like a bit of a placeholder for me.
Indeed, yes, indeed. It did no harm.
Yeah.
I don't know whether you can sort of say it's going to reform the economy tomorrow. But look, it's fine. They won the election. It's their first attempt at doing something. I'm going to be looking with a huge amount of interest in the lead up to May next year, just to see whether there's any more like big bang policy changes on tax and spending and these sorts of things.
Okay, Kouki, we've got our board out here, which has got all the various categories of those things that influence the Reserve Bank in terms of making its decision. We've got the tightening column, we've got the neutral column, and we've got the easing column. Not sure about easing just at the moment, but there might be one or two categories in there. Kouki, take us away, mate. And we're starting off with GDP.
Yeah, GDP, and this is the checklist that unofficially the RBA look at when they sit down each month to discuss interest rates.
I'm calling this Kouki's checklist.
Okay, thank you, Mark. I'll trademark that. But and look, not everything's equal weighting either. Like inflation is much more important than business confidence. But I've got them on there because they are indicators of the economy. So, bottom line issue: GDP growth. How strong is the economy? It's growing over 3.5%. It's in the tightening column.
So they'd like it to be around 3.2, 3.1.
Even a little less than that. They'd want to see it just 2.75 to 3, what we're sort of thinking now for the economy. The fact that we're above 3, they need to keep hiking rates.
Just quickly, though, what's driving GDP up above 3.5? Is it exports minus imports? What are we looking
It's mainly us consumers. Household spending, is very, very strong.
So 70% of the total GDP number is household consumption.
Is what you and I spend at the supermarket, on holidays, for insurance policies. Consumer
so we're still spending too much.
We're spending like crazy.
Like drunken sailors. Okay.
Well, the inflation rate we've already discussed. That's the easy one. Well above the target range. That's well and truly in the tightening column. Easy. The labour market, I'm going to put that in the neutral column because we've had 3 months with no net change in employment, 3 months where the unemployment rate hasn't fallen, and critically, absolutely critically, the various measures of job advertisements, job vacancies are turning down. Now, they're not turning down to say, hey, we're going to be having a problem with the unemployment rate, but it's no longer an issue where the RBA would say, gee, we've got to hike interest rates because the labour market's booming. So I put that in the neutral column. Same with wages, neutral. They have picked up, but they're nowhere near being a problem that we're seeing in the US or the UK where wages growth is way above where it is in Australia. So that one's probably pretty content for the RBA at the moment. The international column. That's one that does go in the easing side.
Because we've got problems.
We've got problems. We've got a high probability that the world economy goes into recession next year. Now, I don't know whether that's, a technical recession or a deep recession, or we avoid recession, but the bottom line, the world economy is slowing. It's slowing abruptly. under the weight of rate hikes, under the cost of living pressures. So that's why we're actually seeing in the yield curve, interest rate expectations in the US, they're factoring in, after a couple more rate hikes through to the middle of 2023, rate cuts in late 23 and 2024, because I think that recession in the global economy will force even the US Federal Reserve to take back some of these rate hikes that are still coming. So I've got that in the easing column, I should say. House prices, I'm moving them to neutral. Okay, they're down 6 or 7% from the peak, but that's after a 26% rise in the prior 18 months. So the RBA, when they look at house prices, look, they don't like it when they're booming. They don't like it when they're crashing. But when they have a correction after a boom, they're content. So I'm putting that in the neutral. That's neither forcing them to hike or to cut. Retail sales, again, another one. That's us spending like crazy. That feeds into GDP. So there's a little bit of double counting here. You know, we consumers are still spending too much. We need rate hikes to stop us spending, to put a bit of money into savings, to get inflation pressures down. Consumer sentiment, that is actually in the easing column. Consumers are gloomy. They hate the cost of living pressures. And even in the budget, we saw that announcement that electricity prices are going to be going up 56% in the next 2 years. You know, my electricity bill's pretty high already, but if it goes up by 56% in the next 2 years, that is serious amount of pressure. It's feeding into this negative consumer sentiment. So on consumer sentiment alone, which is at a level consistent with previous recessions, just by the way, you'd be saying at the RBA, gosh, that's a problem. We want to be careful about that. Building approvals, neutral. They are falling, but that was after a big bring forward during the COVID stimulus measures, the building measures that were put out by both the Commonwealth and state governments. They've come off. We're still building some more, but it's neither stimulatory or acting as a drag. Business investment, neutral. Businesses are investing quite nicely, but from a very low base. You just want to keep that going. You don't want to hike rates because we don't have that overheating, certainly in the commercial property market or anywhere else. So you leave that one at neutral. Businesses, confidence, neutral as well. An important leading indicator. I remember in previous recessions, and I'm sure you do, Mark, that one of the things that predates a recession is when businesses start screaming, we are doing it tough. No one's coming through our door. And we don't have that indicator yet. So I'm putting that in the neutral column. Commodities. I'm going to put that halfway between neutral and easing. You look at the commodity price index, copper, lumber, oil, gas, all these sorts of commodity, copper, they're all turning down, admittedly from a high base, but the broad index of commodity prices is down about 15 or 20%. Hopefully, that feeds into lower inflation. So you're at the RBA, you're thinking, oh, gee, you know, it's not too dramatic at the moment. Stocks, the RBA, of course, doesn't target the stock market, but it's weak. So I'll put that in neutral, but it is having a wealth effect. You know, we consumers, one of the reasons why consumers were spending strongly until like right now is because we had a wealth effect. Stocks were strong until the start of this year. House prices were going up at the start of this year, so we felt wealthy with spending. The fact that that's turning down. And last one, the one that really matters, current interest rates, 2.6%. That's in the tightening column. We're only at about neutral right now.
If that.
And the fact that we've got GDP and inflation, the two most important indicators on our little the monetary policy checklist, the fact that they're the strongest elements in this side of the economy. We've only got a 2.6 cash rate at the moment. Says to me that they've got to do some more. So
where would you put most weight? So you would put the weight on those?
The weight on the top three. GDP, inflation, the labour market, they're the things that matter most. These are all important because, you know, a downturn in the international economy today could lead to our economy weakening. So that's why I've included it. That's why it's important to have this on the checklist. And perhaps saying, well, comes to the question, if you've got a few in that easing or neutral column, do we go 25 or 50?
Yep.
And I think that's where these secondary items, business confidence, business investment, retail sales, that's where these secondary items come into it. Do we need, if they're all in the tightening column, wow, you've got to go 50. Where they were at the beginning of this year, they certainly were. Yep. If there's a bit of a tendency for them to move to neutral or easing, like they were last month in October board meeting when they only went 25, the RBA probably saw a few of these sorts of things. Oh, gee, yeah, we can afford to do 25 and we'll revisit it in November. here we are at the November board meeting. I think we've got that scenario where enough of these forward indicators are in the neutral column. They still go because the highly weighted GDP and inflation and labour market numbers are strong. They'll go 25 in my view.
So your view for the November meeting, which is going to be on Melbourne Cup Day, in fact, about 15 minutes before the Melbourne Cup runs, is another 25 basis points increase.
I think at 25, they follow on and just deliver it and sound in their comment, because they put out a nice 600-700 word statement, what is concerning them. They'll identify the inflation problem, of course, but they probably will flag, like they did last month, at the last board meeting when they only hiked 25, it was the international side of the economy that's causing Dr. Lowe, the RBA governor, most problems.
Yeah, and he actually said in that statement, in about the fifth paragraph, the first sentence of the fifth paragraph, he said there is uncertainty and a global economic deterioration. He used that word, deterioration. I haven't seen him use that word deterioration before, and I haven't
strong word,
and absolutely strong word. And he also used up earlier in the statement. And by the way, I urge anybody, if you want to see what Koukie's done here on a graph, just go and read the statement, because actually, if you read the statement, it just pretty much covers every paragraph.
And I guess so. I shouldn't claim all.
No, it's pretty much what it is.
Yes, but a nice visual version.
But a nice visual version of the statement. But he did say earlier on too, there have been substantial increases in interest rates, and that's a big statement. Again, substantial. The word.
This is the RBA governor. It's not you or me. With all due respect, this is the governor, the guy at the end of the day who decides whether we hike 25, 50, or maybe early in 2023 decide to pause and see how the economy's going.
So I'm agreeing with you. I reckon there's another 25 in November, but I think probably just for good sake, I think they'll give us another hit in December too.
I can't disagree with that.
Yeah.
I reckon the numbers that we get on the labour market between now and then, so there's 2 jobs numbers that come out. We get a GDP number coming out short in early December, about the time of the December RBA meeting. And what happens in the global economy? I think that's the big question. Yeah. If the wheels fall off and that probability of a recession in the global economy in 2023 becomes even more likely, we get bad news coming out of the US, China, importantly, then the RBA, that's going to be a critical thing for the RBA. And just by the way, one thing about the budget, which I thought was under-analysed, if you like, and I do know that Dr. Chalmers, the new Treasurer, is speaking to the RBA. They're still independent on their decisions, but they do talk, as they should.
Yep.
In his budget the other night, he was flagging the global economy as a risk, and rightly so. We would be, foolhardy to be hiking aggressively when you've got the world forecasting a recession next year. You don't want to be doing what we did in 1990, and Mark, I'm sure you remember.
I remember it.
Gosh, Bernie Fraser, I think, was the RBA governor then, kept hiking and hiking. When the global,
I think it was McFarlane.
Oh, was it McFarlane? Gosh, sorry, Bernie.
It was McFarlane.
Whoever was hiking back then, when the global economy was falling in a screaming heap, the RBA here kept hiking, and we had the recession we had to have.
Yeah. 91,
quote unquote.
91, Paul Keating quote.
A shocker, an absolute shocker, because they tightened rates, monetary policy, hiked interest rates, even though they could see, or most people, financial markets could see, the wheels are falling off the global economy. We don't want to repeat that in 2022, 2023.
Koukie, thanks very much, mate. I love it. And we're looking at a 25 basis points increase. Let's see how we go.
Thanks, Mark.